Hans-Werner Sinn is a professor of economics and public policy at the University of Munich. He's the president of the Ifo Institute and director of the University of Munich Center for Economic Studies. He also is a member of the Council of Economic Advisors in Germany, and is a former president of the American Institute of Public Finance. He's written at least 300 articles. I'm not going to go through them for you, but I will say, as a novelist, that I was intrigued by at least two of his titles, one of which is Casino Capitalism, that caught my attention, and the other is The Euro Trap. And so, Hans-Werner Sinn, if you please come talk to us about what ails Europe. We're intrigued. And when you're done, I'll come up. Okay.
Yeah, ladies and gentlemen, excellencies, thank you very much for the invitation to speak here about another medical problem, indeed, concerning Europe. When John Chauvin asked me to come here, I did not hesitate to say yes, because I still have fond memories of spending my sabbatical here at Stanford University 25 years ago. And that was the time of German unification. And then I had to give a lecture to the board of the university, where George Schulz at the time was also, and try to explain what I couldn't explain. And in the meantime, I have learned a little more about all these things. I'm very glad to have seen this great man this morning, and Secretary Baker. I think German unification is something to remember also with respect to the German-American relationship. I think we have every reason to be very grateful to the United States of America for making this possible. At the time, there was also the beginning of the euro. The euro was considered to be a big peace project for Europe. The French wanted it as an exchange for agreeing to the 2+4 negotiations about German unification. And I must say, I was very favorable to this whole idea, because I thought the euro was a big integration project for Europe. I'm no longer that sure. Is the European problem a secular stagnation, as Larry Summers says? I had suspected that sometime also, but I don't think it is this. It is not a secular stagnation. It's not a business cycle problem. It is not a problem which we can easily solve with Keynesian demand measurements or with pouring money at the economy. It is a problem of bursting bubbles in Southern Europe, and these bubbles burst because the American crisis swept over, and they came about because of the euro. How come that the euro created bubbles in Southern Europe? The reason was that the euro reduced the interest rates because it reduced the exchange rate uncertainty. In 1995, there was the Madrid summit. At the Madrid summit, the timing of the euro was specified, and it was clear that by 1999, the euro definitely would be introduced as a virtual currency, and then 2002 as a physical currency. And it was also made clear that by May 1998, the exchange rates would be irrevocably fixed. And so within 2.5 years' time, the interest spreads disappeared. Before that date, investors who lent their money to, say, the Greek state were not sure what the peseta was worth when they would get it back. But with every day approaching this May date, 1998, this exchange rate uncertainty disappeared, and so the spreads disappeared. And that meant that it was very attractive now to borrow. In Spain, private people borrowed to buy real estate. There was a real estate boom created that way. Greece, which later joined in 2001, had a slightly different development because there it was mainly the government that borrowed. The government borrowed in order to increase the wages of the employees and to hire more people. These wage increases in Spain and in Greece, which were basically credit financed, and they were going faster than productivity increases. And that meant that the price level increased. And this increase in the price level destroyed the competitiveness of Southern Europe. This truth became clear when the American crisis swept over to Europe, 2007, 2009. European banks had invested lots of money in America, and they had write-off losses, and they all became much more risk-averse after that and were shying away from Southern Europe, withdrawing their funds, and so the spreads again went up. This time, investors were afraid that they wouldn't get their money back because of bankruptcies, and initially they were afraid they wouldn't get their money back because the countries in Southern Europe used to inflate their economies and devalue to compensate for it. It seems that the period during which the euro has functioned just was 10 years. There were spreads before, there were spreads thereafter. The truth again came true. Now, the price increase was enormous. In Spain, the price level measured by the GDP deflator relative to the rest of the Eurozone increased by 25%. It is as if they had their peseta and revalued the peseta by 25%. And that has destroyed the industry. Industrial output, manufacturing output in Spain now is 30%, 28% to be precise, below the pre-industrial level. In Greece, it's the same, 28% below the pre-industrial level. In Italy, it's 25, 24% below. In France, even, it's 17%. France actually is not in the center of the crisis, but it is very much affected because a simple model of Europe at the time was that the funds were being lent by German banks to French banks, and the French banks distributed them in Southern Europe, and Southern Europe bought the German Volkswagens. So this triangle is basically what happened. And now Southern Europe is in trouble, and so France is in trouble, the French banks. But also the German banks, of course, who were lending directly. Second biggest lender to Southern Europe. The third biggest is British banks. This bubble bursting, which occurred in 2007, 2008, meant that all of a sudden, or came about because all of a sudden private investors were no longer willing to finance the huge current account deficits that had built up in Southern Europe. And they even wanted their money back. There was capital flight in addition. How did the Southern European countries finance the lack of money? They financed it with a printing press. We have a decentralized system, a little bit like America. America has 12 district feds, and we have our national central banks, and they have access to the printing press and can lend out this money to the local banks to compensate for the missing private credit, which was no longer coming. Of course, according to the rules of the ECB. But the ECB has changed the rules persistently throughout the crisis by moving to a full allotment policy, and in particular by reducing the collateral requirements for this refinancing credit. Mind, in Europe, money creation is a little different from America. Usually, the central banks lend out the money to the banks, and the banks have to hand in good collateral, assets which they have. In America, we have more direct asset purchases. And it turned out that there wasn't enough good collateral. So banks quickly run out of good collateral, which they could hand in to get the money from the printing press. So what the ECB Council did in that situation is it gradually reduced the collateral requirement, step by step, measure by measure. I have written a book, the Euro Trap, came out with Oxford University Press in the last summer, and one full chapter is exactly on this difficult process. So step by step, larger fractions of the balance sheets of the banks were made available for being handed in to the local central bank, which printed the money to replace the capital market. That was the solution for the time being. In the first 5 years of the crisis, Greece, for example, financed its entire current account deficit by the printing press. Let me now talk about Greece. You have seen that interesting picture. Alexis Tsipras and Mrs. Merkel and our finance minister and Varoufakis obviously have problems with one another. You see that every day in the newspaper. Greece will have to devalue its currency, would have to devalue its currency, did it have one by itself, by about 30% to regain competitiveness. But they don't have that currency and they cannot. That is the major difficulty. They can mimic this devaluation by cutting their prices and wages. We economists call that real devaluation. But this is a very, very painful process. Keynes had already, in a letter which he wrote to Churchill in the 20s, warned Churchill for going into the gold standard at overvalued prices, because he said, we can never reduce these prices again. You have to fight the unions. The unions will not agree to an orchestrated wage cut. You cannot orchestrate that. It will be a disaster. And it was a disaster. The gold standard was a disaster. And Britain, in the end, 31, could escape by devaluating. Germany could not escape because its reparation payments were fixed in terms of gold. So there was a fixed exchange rate between the Reichsmark and the gold, which the rules foresaw. So Germany was stuck and imprisoned in this gold standard, and it's the same type of imprisonment which we see now for Greece and Southern Europe. One would like to escape, to devalue, one cannot. In Germany, a real devaluation took place at the time from 1929 to 33. The prices declined by 22% and the wages by 28%. And that was a recipe for disaster because there was shooting in the streets. We were at the brink of a civil war. And what came in 1933 was worse than a civil war. That's the situation which we now have in Greece. Not quite, because there's of course not shooting. There's lots of money being given to Greece in replacement of the missing capital market, and that prevents this sort of disaster. But otherwise, it could be similar. How much money has Greece received by now? 5 years ago, when we had the first Grexit debate, it was 48 billion euros extra money from the printing press, as measured by the so-called target balances. And now we are standing at 308 billion euros, public credit, more than 6 times as much. Because in addition to the money from the printing press, came public rescue operations of various kinds. And the rate of unemployment is now twice as high as it was 5 years ago. So obviously, this process did not work. In other southern countries, it's not quite as extreme, but it is very similar. I mean, it's not easy to compare Spain with Greece. It's a completely different country with a productive base in the north. Still, the degree of realignment of relative prices, also for Spain, would be in the order of 30%. It will be a very hard process to carry that out in the Eurozone. There are basically 4 possibilities now for Southern Europe or to handle that problem. I wouldn't say solutions. The first is we finance these countries from the north permanently. The north finances the south permanently. We gradually move into a transfer union, and that's, I think, what we are doing in the moment. There's more credit being given to redeem the old debt, more credit, debt relief, interest rates are reduced to 0 for a long period of time, and so on. So gradually the credit moves to an outright transfer. That's the first possibility. But it's not so good as it sounds, because it makes these countries drug addicted. We call that Dutch disease. When the Netherlands found gas, they were able to raise the wages because they had lots of money from the gas, and that reduced the competitiveness of its export industry. East Germany is in a Dutch disease. The Italian Mezzogiorno has for 50 years been in the Dutch disease. We would drive 40% of the Eurozone population into a Dutch disease situation if that was the solution. The second is we deflate, but I told you that it is difficult. That's the argument of Keynes. In addition, today we have the problem that these countries came into their difficulties because they borrowed too much. So households and firms are over-indebted, and you cannot cut wages and prices, then they cannot service their debt. The third possibility is we inflate the Eurozone sufficiently to allow the southern European countries to just stay behind in this inflation process to gradually regain their competitiveness. And that is what the ECB is currently trying to do with its quantitative easing program. I think it will, by and large, be a possibility because it drives down the euro, as we have seen already. All this money has to go somewhere. Some goes abroad, and that drives down the euro, and that will automatically lead to inflation. And if Greece, Spain, and other countries are wise, they stop and fix their prices and let Germany inflate away. So it would be a process of Germany following this inflation trend of the southern European countries, and thereby gradually making the south more competitive. That's a possibility. The inflation rate, though, would be large. So if, according to our calculations, if no one cut his prices or their prices, then the German price level would have to go up by 50–60%. That's quite a bit. The time period is not important for this calculation, not in 1 year, of course. If this process is too slow, if QE doesn't work, if the hardship continues, then we have to consider a fourth possibility, and that is an exit. I think the exit is not such a terrible event as it is often proclaimed. The euro cannot be like the dollar because we have not created the United States of Europe yet. And before we haven't done that, the euro has to be a slightly different kind of thing. I think something between the Bretton Woods fixed exchange rate system and the dollar. And here I think it would be useful to have a breathing currency union. Something where you can exit if it is necessary and return at a later point in time. If Greece exited, return to the drachma would immediately devalue, say by 50% or so. What would that mean? It would mean that Greek consumers would stop buying agricultural products in net terms in the rest of the world. Currently, they buy the tomatoes in Holland, while agriculture is their only comparative advantage next to tourism. So they would go to their own farmers rather than buying the expensive imports, and the own farmers have more business, they employ more people. Effect number one. Second effect would be the tourists would return from Turkey back to Greece. It's basically very similar. You have the better temples, perhaps even in Turkey nowadays, better Greek temples than in Greece. But with lower prices, they would come. And third, all this capital flight which we have seen from Greece to other countries could be reversed. So there are lots of rich people from Greece who have stored a lot of wealth outside the country. And if everything becomes cheap, they would return, buy real estate, they would build, there would be a construction boom. And hopefully they would not only reconstruct their villas, but would also build some factories. And then perhaps the old cotton and textile industry, which Greece once had, which the euro destroyed, could return. So these would be the basic effects. In the Ifo Institute, we studied, on the basis of the Reinhard Rogoff data set, 70 cases of bankruptcies and devaluations, and found that typically 1 or 2 years after the devaluation, the economy began to recover. Why should this be an exception? And then one would give the Greek people the hope to return. If the exchange rate has found its new equilibrium, and if reforms really have been carried out, then at a later point in time, say after 10 years, they could return. This is better than leaving or losing one generation of young people in this mass unemployment. Of course, we would have to help the country also on this process by providing subsidies, say, for the import of medical products and things like that, which become now expensive if one exits. But it would be much better and cheaper for everyone. If we don't do that, if we keep Greece in, it's a bottomless pit. It will go on like this forever. And that we cannot afford. Why not? Because the political contagion is enormous. If Greece is treated this way, other countries would have to be treated the same way. Suppose we gave the others also 170% of their GDP as public credit, as Greece has received. The 308 billion is 170% of GDP. We do that with the other southern European countries, then we are above 5 trillion euros. No way we could repeat that. So every country has to decide itself, in my opinion, what to do. Whether they would go through the painful reform process within the euro, doing a gradual devaluation by disinflating relative to Germany, hoping that Germany inflates now because of the QE program, or this process is too painful and they exit. No one else can make the decision instead of them. In the end, I hope that Europe will become something like the United States. I laid down this in the last chapter of my book. I think instead of reinventing the wheel, though, we'd better copy the rules in America. Another country to copy would be Switzerland, which also functions well with different ethnical groups in the country. But we have to make sure that we construct these United States of Europe in a way which is feasible And the most fundamental thing there are two fundamentals which I would like to emphasize. The first is, if you really create the United States of Europe, then you have to have a unification of the armies. In the moment we have these separate armies in Europe, and we try to socialize everything, but not the army, which is a very strange thing. Juncker, the president of Europe, has recently raised this issue, and I think he is very right in doing so. Second, we need a government with a budget like in America, but what we do not need is a system of debt mutualization, as many ask for. This, I think, is very, very essential. Many think, well, if you have problems in Europe, you just mutualize your debt and then everything will be fine. I don't think a federation can ever work with debt mutualization. There are two ways of generating or creating a federation. The one is the European mutualization model, which we have started with all these rescue operations. And the other is the self-liability model, I would say, of the United States or of Switzerland. If California is in difficulties, it was in difficulties, and close to bankruptcy, then no one comes to help California. The federal government does not help California. Neither comes the Fed and buys Californian government bonds. But that's what we have done. If we would implant the European Central Bank to America, it would now begin to buy Californian government bonds of Minnesota, of Illinois, other states which are in trouble. And what would these states do? Print more, issue more government bonds, rather than tightening their belt. And the same in Switzerland. If a canton in Switzerland goes bankrupt, there is no one to help the creditors. The creditors know that it is their risk, they would not get their money back, and therefore they are very cautious not to provide the money in the first place. A market economy can only function if we have bankruptcies, and so it is with a federation. Investors must be the controlling agencies and must shy away from countries that overborrow. That's the only stabilizing device which can function. I would like to remind you of your own history. When Alexander Hamilton in 1791 mutualized the state debt, he argued this would be cement for the new American state. There was a second round of debt mutualization in 1813 in the Second War against Britain. And then the states thought, oh, well, you can as well borrow because the burden of the debt is shifted to the federal level. So they borrowed. They built roads, canals, infrastructure. Not everything was useful. Many canals were useless because later the railways came. But in the process of building all these things, there was a wonderful boom. The bubble, however, which it became, burst in 1837, and from 1837 to 1842, 9 out of 29 American states and territories went bankrupt. And the others, which were not bankrupt, were handicapped enough not to be able to assume the debt. So nothing but hassle and strife was the result of the experiment of debt mutualization. Harold James, historian at Princeton University, argues that Hamilton's debt mutualization was not cement for the new American state, but it was an explosive. And he drew a direct line from 1842 to 61, arguing that not only the slavery problem, but also the unresolved debt problem had contributed to the American tensions. And only after the Civil War were the new rules of America established, namely the no bailout rule. That is, states promise not to borrow too much. They had their legislations. And in addition, if they did, it would be their own fault and their creditors' fault, and the creditors would have to bear the losses. And this system has brought stability to the American nation up to this point. We should learn the lesson of history and try not to repeat the mistakes of America, but to copy the model the way it works today. Thank you very much for your attention.
Two comments before I ask the first question and then start calling. One is I apologize on behalf of SIEPR for the randomization of your slideshow. And I know that made it difficult, but you certainly recovered nicely. The second, yeah. You also killed a stereotype that Germans don't have a sense of humor. The second point is one who lives in Charleston, South Carolina. I will add that holding these unions together is difficult, and may oftentimes not only go awry but totally fail, which this one almost did in 1861. Question for you: if I assert to you that God came down to me and gave me a tablet on which it said that the euro will become 2 euros, which is a special case of your number 4, the exit. So instead of just exiting piece by piece, basically God were to assert that there are 2 euros and they exist and that is a system that could be made to work. In your professional estimation, when would this come about? I'm asserting that it will. When would this come about and how painful would the process have to be?
Well, there are proposals to have 2 euros. The question is where the borderline is between the 2 euros. If it was the Rhine, I would not be very happy about this because after all, the euro was a unification project between France and Germany, and as such, I defend the euro. If that wasn't the case, just for economic grounds, I would be much more skeptical. But that's worth lots of effort to keep this axis intact. This goes a little bit too far for me. I would leave it up to history. But I would say, let's start with Greece, and then we see. If another one wants to follow, if it works, yeah, why not? Why not? Why is it such a catastrophe? And let's have a more flexible approach. I don't think that these extremes, which beliefs which are ideological, I find, or utopian, everyone stays forever in the euro, will lead us to something. Because if we really mean this, then there will be lots of more hazard effects. That's a promise. You can do whatever you want. You will be bailed out forever. That cannot be the case. No club, no institution can function without rules.
I would assert that South Carolina is being bailed out forever, but I'll let that go. Okay, are there any other questions? I know there are questions. So over here, when you get the mic, could you introduce yourself and then ask the question, please?
Sure. My name is Mike Spath. Question for you. In terms of, if let's say there was no euro and there was still a Deutschmark, the Deutschmark would be significantly higher now relative to other currencies. German unemployment would be higher than it is. Germany would be less competitive. So there's tangible economic benefits that Germany gets for being part of the euro. So part one of the question is, what do you think, do you have an estimate of what those benefits would be? And then the other part of the question would be, what would Germany be willing to pay for those benefits? Obviously some number less than X. And how could Germany, because it seems like there's no structure for them right now to be paying for those benefits. So they're receiving benefits for being part of the euro. There's no structure for them to give benefits. They are lending money. They are providing liquidity. How do you think they should pay for that? Because it seems, in my mind, that there's no functioning mechanism there for them to pay for the benefits they're receiving.
Yeah, well, this is often said that Germany benefits from the euro. I see that different. I think no one really benefits from the euro. In hindsight, it was a big mistake to introduce it at the time. But now we have it. It's like a marriage, you know. It's not functioning, but it doesn't mean that you divorce because the divorce cost is so high. Looking at exports is a little bit too narrow because there are other sectors of the economy. Of course, if you ask the German export industry, they find the euro great for obvious reasons. But there are other sectors of the economy, and there are consumers after all. Germany is way too cheap. We need a revaluation at the expense of the export industry to bring resources more into the internal sector of the economy and increase the living standard of the population. There would be terms of trade gain. Why can I say that? Because Germany has the world's largest current account surplus, larger than China's, 7.5% of GDP. This is absurdly large. So the German model in the moment is to sell cars to the world in exchange for debentures. We accumulate all these letters that someone will repay in the future, and it is not even clear that that will ever happen. So this is unsound. We have two huge export surpluses, and some revaluation would be good. Concerning the gains for Germany, I give you a number. In 1995 at the Madrid summit, when the euro was ultimately decided, as I said, Germany was number 2 in the ranking concerning GDP per capita among the now euro countries. Number 2 after Luxembourg. And what is it now? Number 7. We fell down to the 8th place until Lehman. And during the crisis, Germany moved ahead from the 8th to the 7th place. Why was there this performance? Well, because the euro meant that capital was lured out from Germany to other countries, partly in Southern Europe, partly America, partly Eastern Europe, where low wages attracted lots of investment. So that was the initial phase. Some 10 years ago, 12 years ago, we had a really dramatic situation with more unemployment than France has today. And that was a period when Germany had the lowest rate of growth, had it for a couple of years, among all European countries. You could draw the line at the Ural. So the initial phase under the euro was very painful for Germany because the capital was leaving the country. And that led to a slump, to mass unemployment, and forced the government to carry out reforms. Basically, the Schröder government at the time reduced the implicit minimum wage in the German welfare system by depriving millions of Germans of their second-tier unemployment benefits and pushing them down to welfare. And that implied that they had to be satisfied with much lower wages. And at lower wages, gradually over the years, more jobs were being created. And then came the crisis. And the crisis, paradoxically, made Germany grow. Why did it make Germany grow? Not immediately, 2008, 2009. But beginning in 2010, there was an enormous internal construction boom in Germany, because the capital didn't dare to go abroad anymore. The ships stayed at home while there was a storm in the sea. You can also say there was a flight into beton gold, as we say. The investors didn't know where to go. What should they buy? Greek government bonds, structured American securities? No, everything seemed to be very risky, so they went into real estate, and we got a real estate boom. Not despite the crisis, but before the crisis, because of the crisis. Countries do not only depend by making trade in commodities, there's also a capital market after all. And the relationships between goods market and capital markets are complicated. When one country booms over the goods market, it buys the goods of the other country, and that also booms. So they go in parallel. But capital market is reverse. If capital goes from A to B, B booms and A goes to the slump. And that was the case in Europe. A was Germany and B was Southern Europe. Southern Europe went into this boom, incomes increased, people imported more, they got current account deficits. In Germany, there was very little investment, the economy slumped, and because of the slump, the income didn't grow, the imports didn't grow, we received an export surplus. So interpreting this export surplus as a sign of a particular gain is absurd, to be honest. It's absurd because it was the capital flight which induced it. It's not always the case that the capital account drives the current account. Sometimes it's the other way around. It's a complicated story. But this phase of history you can only understand through this story.
Arminio, and then Henry.
Arminio Fraga. It's a quick comment and a question. So picking up almost where you left it, German 10-year bonds are now at 20 or 25 basis points in yield, and still has been very difficult to create inflation. And this for a Brazilian is a bit strange. If you told me 10 years ago that the world would be having trouble inflating, I would have said, no way. So what is your interpretation of this? Why has it been so difficult?
To inflate the Eurozone. Yeah, well, Germany doesn't like to inflate. Traditionally, we have always had very low inflation rates, and Southern Europe cannot inflate. It has to deflate. It's in a process of stagnation where its only rescue is a realignment to the downside of relative prices. And that's what I said. Doing it in absolute terms is very difficult and problematic. In relative terms, by having Germany inflate is easier. Maybe Germany will inflate. I think Germany will now, through the QE program, go into inflation. That will work. It's a very powerful policy tool. We see already the strong devaluation of the euro, and that automatically means that we have inflation because the import prices go up immediately. And then the exporters will be able to increase their prices and increase their profit margins. And that will, these are two channels through which the devaluation will lead to an inflation. I think not very much inflation, but currently we have a slight deflation. And the idea of Mario Draghi is to increase this inflation rate to something below 2%, slightly below 2%. I am rather optimistic that he will achieve that.
Henry Aaron?
I'd like to raise a question that I think you probably run into in other contexts. You suggested that a permanent transfer of resources from the north to the south is really not sustainable, and that it would be desirable for Europe to learn the lessons of the US federal system. But the US federal system has entailed precisely such permanent transfers from the north to the south. But it occurred not through financial markets, but through public finances, and this has prevailed at least since the 1930s. So there are different mechanisms by which such transfers can occur. Is it not possible that one element missing from the equation currently in the European Union is a mechanism through the public finances for such transfers? They occur in the United States through unemployment insurance, they occur through Social Security, they occur through a national income tax, which falls more heavily on the North than the South because of income differentials. Such mechanisms might arise in Europe. Could they not serve as the bridging mechanism that you seek for facilitating the maintenance of the union while these differences over a very extended period of time are worked out?
Well, if we do have a strong federal government, I said we need a federal budget, I agree. Then we can have the automatic transfers which come through the existence of a federal budget. The problem is the sequencing. Can we do that right now before having created this federal government which has the power to implement the rules of financial conduct and so on which go with them? That I doubt. For me, this is also something which will destroy the Union. We will never get the United States of Europe if we introduce this now. It's the following problem. Again, think of Mrs. Merkel and Mr. Tsipras. Well, suppose she loves him, which is not true. But he loves her money, which is true.
Right.
The question is, they talk about marriage. Should the money already be handed over before the marriage or after the marriage? That is exactly the nature of the European problem.
Anyone over there? Question here? That's very nicely done.
So I very much enjoyed your talk so far, Professor Sinn. So I have a question on, it must be very frustrating for many of the leaders in Europe to, like the ECB and the IMF, when they're dealing with countries like Greece on a high level, to find agreements, sign agreements after a lot of work, and then the people inside the country, in this case Greece, decide they don't want to play along. And so that a lot of these agreements that have been signed in the past just don't get accepted by the people who are currently living in those countries. And I'm just wondering, how can one better connect the leaders with the people? What can be done to make the people happier so that they support what the government is doing? Maybe education, or I think handouts is going too far. But what can be done to make the people happier so that they will support the agreements going forward?
You mean Greece in particular? Well, devaluation. The devaluation will create wonders in the labor market. Because then people have jobs. You know, yes, the German car or the Korean TV set becomes too expensive, okay, then they stop buying that and continue with the old. It's not such a problem. The haircut, the restaurant, everything keeps the price level, and they find jobs because there is demand for their products. It's a more natural situation. And you know, when people are not in mass unemployment, then they are happy. There is not such a thing as an absolute living standard. That's of secondary importance. If they can buy things which they need for their everyday life, rather than expensive imports. So there is a possibility. That is, I mean, most of your economists, I assume, this is nothing new which I tell you. Devaluations are the recipe for solving the problem. Politicians don't talk that way. They talk about reforms and productivity miracles and so on that might happen. But even, you know, reforms can only operate to the extent they drive down the price level. The price level is the result of productivity and wages. If we have a productivity boost and the wages increase in par with productivity, then the competitiveness will not increase. A competitiveness problem is always a problem if the living standard, which is represented by wages, is beyond the productivity. The least productive country of this world can, of course, be competitive if its aspirations and wages are in line with the productivity. But once you try to deviate, then you are running into a disaster. And that happened in Southern Europe through the availability of cheap credit. You can say why this cheap credit was there. The capital markets were stupid by lending. Well, there was also regulatory mistakes. The banks were really induced to load their balance sheets with government bonds of Southern Europe. And the existence of the euro, the bailout promise coming with the euro, also implied that too much capital was going there in the first place. And that created all this mess. This allowed the living standard to be developed beyond productivity. That was the issue. And we have to correct it. It is as if you have a drug addict. You get drugs, and as long as you get the drugs, it's fine. In the moment we are giving new drugs, that helps, and everyone is happy, but it is not a real solution to the problem.
Okay. We have time for one more short question and one short answer.
Will United States of Europe ever happen? Will Germany ever support it?
Well, I think given this horrible past of my country, there is an overwhelming majority of Germans who want the United States of Europe. But there is an overwhelming majority of French who do not want it. That is also one of the fundamental problems of Europe. One president after the other in France has declared he does not like this final goal of moving to the United States of Europe. And that is this dichotomy, which in the end, if we now continue to go on as we did in the past, could destroy very much consensus. The euro thus far has not been a peace-creating institution. I've never seen as many tensions in my life between the countries of Western Europe as now, and it is a direct result of the euro. Because the credit bubbles in Southern Europe, which deprived Southern Europe of their competitiveness, would never have happened without the euro. I mean, it would not have been a satisfactory situation either. They would have inflated, devalued, what Italy and the others did all the time, but there were jobs after all, and it was a possible solution. And now they are trapped. Southern Europe is trapped in the euro, and Northern Europe is trapped in a liability situation where the lack of competitiveness of the South has to be compensated for with transfers, which makes the people also unhappy.
Thus the title of the book, The Euro Trap. Any questions about 50 Shades of Grey for Hans-Werner? Okay, well, thank you very much.